I'm a big geek about investment analysis, and I like things like capital gains, and I like talking about depreciation for tax purposes, because as a professional investor now for 30 years, I know the relevance of those particular topics, and knowing how to utilize them makes or breaks real estate investment decisions. But it's always hard with our particular channel here to find something that's relevant to our test-taking audience. So what I do here is I'm going to go ahead and jump into two particular videos, both of which, one is capital gains tax and one is on depreciation as relevant to taxation, because those two question styles are going to be on real estate examinations. And what we've done, as a matter of fact, is that plus several other math topics we've included in our brand new book. And this book covers every stitch of math that you could possibly have to worry about for that examination. I love to strip away as much of the nonsense that you have to not worry about for exams and try to focus only on the content that you do. And this book has achieved that. So check it out. I'll drop a link in the description below. And without further ado, let's check out these videos on capital gains, taxation, and depreciation for tax purposes. We'll see you on the other side. What are capital gains in real estate? Capital gains represents the profit made from selling an investment property for more than its original purchase price, basically, is what a gain is. There are types of capital gains. There are short-term capital gains and there are long-term capital gains. Apply to properties held for 1 year or less and are taxed on a federal level at the investor's ordinary income tax rate are short-term capital gains. So, could be significantly more expensive. Long-term capital gains apply to properties held for more than 1 year and are taxed at lower rates, 0% potentially, 15% or 20% depending on income levels. Note, for state taxes, the treatment of short-term capital gains varies by state, and the state capital gains tax rates are also all different. We're looking at this from the federal perspective, just FYI. So how do we calculate capital gains in real estate? The formula is the capital gain equals the selling price minus the adjusted basis. The adjusted basis is the original purchase price plus the cost of capital improvements, not routine maintenance. So suppose an investor purchased a property for $400,000 and invested $100,000 in renovations. They sell the property later for $700,000. The adjusted basis is $400,000 plus $100,000 or $500,000. The capital gains is the selling price minus the adjusted basis. Therefore, the capital gain is $700,000 minus $500,000, which gives us a gain of $200,000. So where does sort of the rubber meet the road? The tax implications. Okay, so if the investors held a property for at least 1 year, they would be subject to the long-term capital gains rate depending on their tax bracket. So for example, 15%. So the tax owed is the capital gains times the tax rate. In that example, it's the tax owed was $200,000 was the capital gain times a 15% tax rate, or $30,000 is the tax owed on the gain. If the investor held the property for less than 1 year, they would be subject to the short-term capital gains tax rate depending on their tax bracket. So they could be, let's say, at a 32% tax bracket. Then in that case, the taxes owed is the capital gain that we realized, the $200,000 times the tax rate. The tax owed then would be $200,000 times 0.32 or $64,000, significantly higher than the $30,000 long-term capital gains rate. So the long-term investor, again, looking to hold the property much longer term might be better. Short-term gains, you might get a score in the investment business and you want to sell it quickly, all good, but just remember that the gains tax rate is going to be higher depending on the tax rate of the individual or the spouse. So you want to make sure that you understand that the gains that are realized and the tax associated with those gains could be significantly different based on how long we hold the investment. Okay, the next glorious thing that we have is depreciation for investment properties. So tax depreciation allows investors to deduct the decrease in value of an asset over time due to wear and tear, age, or obsolescence. The IRS, the Internal Revenue Service, uses a modified accelerated cost recovery system to spread the cost of an income-producing property over its useful life through annual tax deductions, reducing taxable income and increasing cash flow. So this is a benefit for the investor. The MACRS uses straight line depreciation methodologies, meaning that the same amount of depreciation is deducted each year over the asset's useful life. Depreciation periods are things that they like to put on exams. So for residential rental properties, it's 27 and a half years. For commercial properties, it's 39 years. You want to memorize those. And note, only the building's value can be depreciated, not the land. So we cannot depreciate land except in very, very unique circumstances. So for the most part, it's only the building, not the land. All right, let's take a look at calculating depreciation deductions. So an investor purchases a residential rental property for $500,000, where the land is worth $100,000 and the building is valued at $400,000. The depreciation calculations is the following. The annual depreciation deduction equals the building's value divided by the depreciation period. Since it is a residential property, the building's value would be depreciated over 27 and a half years. Annual depreciation equals the building's value divided by the depreciation period. When we look at the numbers, it's $400,000. Remember, we don't depreciate land, so it's just the building's value divided by 27 and a half years, which means an annual straight line depreciation deduction of $14,545.45 annually. The tax benefits of depreciation. So now we have the annual depreciation deduction calculated in the previous example of $14,545.45 by deducting $14,545 from their taxable income every year. For the next 27 and a half years, the investor reduces their taxable income, resulting in lower taxes and increased cash flow from the property. So depreciation is magic. And capital gains taxes are based off of long-term and short-term gains. So this were great sort of understandings of these things. And keep it simple for the real estate examination. Later, once you're licensed and you're investing and you're doing whatever you're doing, then start to deep dive into this stuff. You're going to love this stuff. It's super geeky. I love it. It's really the understanding here of where the magic is in investing in real property. All right, I hope you found those two videos helpful. Again, we're trying to find this crossroads between what's relevant for exam takers and sort of something interesting that it comes down to investment analysis and understanding those further. All right, I wish you much success in your studies. I wish you success on your examinations. And any of y'all budding professional investors out there, good luck with your investments. Think about capital gains tax now and think about depreciation, as those are magical things that we have to understand before we put on our investor hats. All right, see you on the other side.